All right. Like we're live. Welcome, everybody. I'm Midas of Midas Investing. Welcome to our second episode of Macro Matters, our quarterly show where we go over economic data, what's going on in the economy, trying to figure out things are gonna be looking like going forward. It's been a little bit of a while since our last stream. Uh, Sorry about that, everybody. Everything's been pretty busy in my personal life, and honestly, I wanted to spend a little bit more time before kind of coming back to streaming a little bit more regularly. I was trying to kind of like figure out a way to make this a little bit more regular, a little bit easier on myself, and that were kind of required, I think, a little bit more planning ahead. So that's kind of what I've done. So my plan is to try to stream once every other week, but I do kind of have like a plan in place for the type of topics I'm going to be talking about in each of our shows on a kind of quarterly basis. Like in a quarter, there's approximately uh, you know, four weeks per month, and then 3 months in a quarter, about 12 weeks or so within that, which means I could do 6 shows. That's give or take. Obviously, there's like an extra week in there that pops up, depending on like the cycling of the weeks within the month and stuff like that. So be a little bit an extra show in there sometimes as well. But the point is, I have to have a sort of plan of like what I'm going to fill out those shows with. So the first show in the cycle, which I technically did a Q1 economic update last quarter. So here we are, about a week or so, almost 2 weeks technically, past the end of the quarter for Q2. So now we're going to do our quarterly update on that. And it is going to basically always be nearly 2 weeks, between 1 week and 2 weeks afterwards, because I do kind of like to wait until about this amount of time, because then you get uh, both the employment and the inflation reports for June, which means I can get that data included in the discussion. It's like there's always a lag to when economic data is released, so you kind of have to like think about when best to talk about what information based off of what's actually available and the timing. So anyway, here in front of us right now, obviously, is my portfolio. We're not going to talk too much about my portfolio here today. Well, at least not up front. Maybe depending on how fast we get through this information, if there's like people in the chat, depending on how many people show up or not, because obviously it's been for a while. So who knows? It might be mostly just me talking about econ data today, which is fine because technically I have a lot of it to go through. But maybe we can talk portfolio stuff a little bit more later. But for today, it is mostly I'm trying to talk about the economy. So that is what it is. But I will at least kind of give you a brief update on any changes here, which there isn't much to talk about. I have bought almost nothing in the last 2 months. I think like literally my last individual uh, picks, my last individual buys with some more FG in early May, and so I haven't done any purchases since then. Although I do want to do more. In fact, I would like to buy more FG. I did actually make some changes to my ETF holdings here a little bit, because I've kind of shifted my macro strategy around, which is one of the things I actually did spend a lot of time in the last month or two doing. Uh, I've been kind of doing a whole lot of economic research and macro strategy research, which I know is not necessarily something that is as attractive of a concept to, I think, a lot of my viewers. I think some of you guys probably find it interesting, but most of you guys, I think, are more just interested in value investing stuff. But nonetheless, that's the kind of stuff that I'm interested in, all sorts of other types of stuff. So been researching those macro strategies and stuff like that, as well as my option strategy. But I did actually put together also um a new DCF template. So also been doing stuff on that front too. But the point is that part I only kind of just more recently put together, and I've kind of been like testing it out on my existing holdings here. So it's basically ready to start being in use more full time, which means over the next month or two, hopefully that means I'll be doing a lot more individual research on that, because that's kind of what I've been doing, is a lot of stuff to kind of set myself up to make it easier for me to frankly value a lot more companies a lot faster. And my old template, I liked it for a lot of reasons. It was really, really great, but was in some ways complicated to implement. And not just because of the template itself, but also because of my dashboard, which frankly, my dashboard and me trying to integrate my valuations into the dashboard, it was great for like how it presented, but it was a little complicated for me to like maintain behind the scenes in some ways, and that slowed down my process of actually like getting valuations done. So my new template was geared in a lot of ways towards trying to fix that problem, but also trying to expand on some of the functionality, which we'll get to probably in our next show. We'll probably talk a little bit more about that. But like I said, maybe we'll talk a little bit about that near the end of the stream, depending on who's still here or not, is interested in discussing that. But like I said, for today, we're mostly going to talk about economic data. So let's go first over to my business cycle my business cycle archetype that I've shown in a few different streams over the last like half year or so, and I showed a decent amount of it in the last Macro Matter show a quarter ago. Here I have different parts of the business cycle shown in their kind of median pathway going in and around a recession, with the recession essentially beginning at this black line, and then this being like however many months before the recession, and this being however many months after the recession. And all of these are essentially like composite signals of various pieces of it. So we have like employment, and this is showing like the median pathway of what employment does prior prior to and going into recession. Stocks shows the pathway for that. See all these different signals here. And this is kind of like one of the ways I like to track the business cycle, is kind of paying attention to all these. So this is what the normal recession pathway looks like. And then I like to say, okay, well, what does those signals all look like today? So looking at what all those signals look like today, this is what it happens to look like. Which right off the bat, the first comment I'll make it just kind of like off the bat is that this is the kind of thing that it looks more like we bottomed some time ago. Like this is kind of, it looks more like we were declining and then we were bottoming. That declining, I would say, is a little skewed by the fact that we had such um, a big economic blowout out of the out of the pandemic, and then also out of the kind of rate hiking cycle. We managed to have really strong economic growth. So some of that's just a decline from that previous high level, and not to mention that also includes the policy rate, which is the red line here. So it's kind of shows like the decline in the rate of change of the policy rate growth. So the policy rate was raised really quickly. So that's why the line was up really high way up here, and it hasn't come down actually, but the rate of change has come down, because that's what most of these are based on, is rate of change measures, not actual just flat numbers themselves. Anyway, looking at each of these individually, though, looking at the yield curve. The yield curve has come back into positive territory, which is something that usually only occurs once you're already in recession or right at the start of recession. So it's kind of interesting to see that that's happened like 6 to 7 months ago. A lot of people were looking at the inverted yield curve as a sign that we were going to go into recession. I was one of those people that was constantly talking about that, for example. And then really, we came out of that on a median basis. The behavior appropriate from the yield curve about 6, 7, 8 months ago. So in many ways, this looks more like we are coming out of a recession. Liquidity, this measure in particular, does look a little bit more like we're going into recession territory, or like I said, you could kind of line it up a little bit differently. This all these kind of assume that today is the beginning of the recession. So that's why the red line, it starts here. It says, if today was the start of a recession, does it currently look like the median pathway, which is the blue line kind of shows you right here? So this one definitely is a little bit more negative looking, but only one of several signals. So kind of looking within that. And then also part of that has to do with the dynamics involved with the Fed and them doing their tightening cycle. So the fact that they're kind of coming to a close in their tightening cycle and moving more into a potential easing cycle means that this is likely to start to recover in the near future. Moving on from there, stocks don't. This is it is kind of going into negative territory from positive territory, but the fact that it's not coming down from a high level is important, because, like I said, again, this is more about a rate of change uh, figure. So this rolling over from a high level to a low level means you have a big decline in stock. So technically, yes, it's going from positive territory into negative territory. You can see here over a few month period, so it is moving back upward a little bit. It's not exactly the same type of move you see, but still not exactly super strong. Stock point is usually you have a big rollover prior to prior to recession. So that's really what it tends to show. Then credit growth, loan growth in the banking sector. This one definitely has some solid weakness to it, but also potentially shows kind of a potential bottoming 3 to 6 months in. But this is one that often has a bit of a lag effect. It does tend to kind of bottom in terms of its rate of change median basis going into the recession, but it doesn't really reach a true bottom oftentimes well into the recession. Definitely one of the parts of the cycle that takes some time in recession for it to properly roll over. So also one of those things that kind of makes it seem like potentially the weakness is in some ways past potentially, but we're still in a negative kind of territory. So it's still something to pay attention to going forward. Then there's corporate profits. Corporate profits, as you can see, typically rolls over going into the recession and then covers. It's a little bit more of a volatile series, as you can see, even on the median basis. And then the current position of it, profits have actually been recovering pretty dramatically in the last, what is this, like 9 months or so, 7 months. So that's definitely one that does not exactly portend a recessionary outlook. And you got to keep in mind that like the higher this goes, the more reinvestment there is, also therefore more potential investment employment. So that's why it's like that this one is a strong factor. It's usually more of a leading factor. The fact that it's pretty strong recovered gives me so it was definitely a positive forward. Um, then there's actual economic growth, is like the actual real GDP growth itself. Definitely coming down from pretty high levels. We did have a few years of pretty strong economic growth, as I said before. So as you can see, we do tend to have a little bit of a rollover in that way, but we are kind of only really recovering more to the kind of typical level, and then it has flattened out in the last 6 months or so. So as of now, it looks pretty good, but who knows? This decline could start to continue. But definitely not negative yet. And then employment, which is usually pretty highly correlated actually with credit cycle, as I kind of showed before, is a little bit of a lagging series. And then employment is also a bit of a lagging series. See right here, really doesn't reach negative territory until like 3 to 4 months into the recession on a median basis, and bottoming more like 8 months into the recession, and then taking some time to recover as well. So employment has definitely been declining, but declining at a relatively slow pace over the last few years. Definitely something to watch in many ways. This is like the most important signal out of all of them. It's the one that's people's jobs, right? It's like that's people's incomes, that's people's livelihoods. So in many ways, like all the other ones are like abstract in terms of like how that like is important to the economy. I can tell you how they're important to the economy, but you kind of have to like think through all those factors of it. But this is the big one in many ways, and this is the big one to stocks too. I would say in sort of long run, it's the one that decides whether something's uh, a quick uh, a quick recovery in terms of a correction, or like an actual crash and bear market that takes a long time to recover. It's like employment is really going to define that for the most part. But then also we have the policy chart, which is the Fed funds rate. As you see, a hugely downward skew from a very high level. In fact, what I would point out is that the red line is on the right hand side, a different y-axis, because of how far of a level fast of a rate is coming down from. And again, that has to do with the rate of change. Obviously, Fed funds rate has come down a little bit, but it hasn't come down a ton. But the point is, it previously had gone up at a very high pace, and so even just leveling off meant that the rate of change of growth coming down precipitously was just leveling off. And then they did bring it down a little bit, and then obviously they stopped bringing it down. And then a lot of people do believe that we might start to get a few more cuts towards the end of this year, or maybe we do have to wait until Jerome Powell is no longer the Fed chair into next year, and then potentially whoever Trump nominates will make the cuts. But the point is, at least sometime between now and the end of next year, it seems basically for sure that we're probably going to get another cutting cycle starting to begin. It's hard to get any more clear than between now and next year. But it's potentially starting to happen. But either way, the point is like right now this is on the wrong side of the scale. So it looks really super low, but right, it's actually at 0.12, which if you look at like on the left hand side, 0.12 is about here or so. So if they were on the same y-axis, it would sort of be about here. So you can see it is low technically already than relative to where it normally is comparative to going into recession, which in many ways makes it less likely that we are going to go into recession, because this is an easing effect, right? Like this is easing off of the tighten. But anyway, the point is that this one also time where you start to see it roll over. Then also the inflation chart. Inflation, this is sort of an inverted measure, because inflation going up is bad. So down is sort of the negative experience of inflation. And so we were going upward pretty significantly, which was the inflation coming down. And then as you can see, it's starting to go downward again, which is actually essentially the rate of change that the inflation was coming down stopped, and we've now leveled off for the most part in inflation. And that's sort of what this shows right here, which means basically the easing of the price pressures stopped for the experience of. That's basically you would explain why negative charts. It's about the experience of the people in terms of the. And as you can see, inflation actually usually peaks well into the recession. inflation is usually high going into recession for various reasons we'll get into a little bit later. It's usually subcategory inflation causing that. And then it declines once the recession has really fully gone on the way, specifically once employment falls apart. Once employment falls apart, inflation usually durably will fall below the trend and come back into kind of the normal range again. So that's one of the reasons that hard to get that there until you have a proper recession. So we won't get to the 2% target. You'll notice they kind of stopped talking about 2% targets a long time ago, even though we never actually reached it. Um, we never probably really will unless we have some serious unemployment. Now we could argue whether or not we care about that. It's like, do we care about 2% versus 2.5% versus 3%? That's a political question in many ways. Um, but nonetheless, point is Fed stopped talking about that target many meetings ago for the most part. They still say in their statement that they are committed to it, but I'm it's much more of like a kind of discussion about the state of employment and stuff like that. But anyway, all these separate charts put together, these are all the separate signals from the overall cycle as I was showing here, but I do like to kind of take all those cycles together and kind of show them all in one composite signal, which is what I have right here. The blue line is that composite signal of basically all those acting in and around recession. So this basically shows, in my opinion, the kind of median behavior of the business cycle before going into, during, and then coming out of recessions. And then the red line shows the median, the overall composite cycle for our current position in the cycle. See right here, it's like, as I had said before, in many ways it looks sort of like we actually bottomed in the economic weakness like 8 to 9 months ago or so, and then came back up. We're not really into fully positive territory, but the point is, in many ways, we've been improving since about 9 months ago, so give or take, by a little bit. We went up a bit and then we came back down. That's probably in some ways like uh, maybe some of the tariff activity right here. We can get into some details about that a little bit later. And then the yellow line right here, what I do is I kind of like take that same line and I just reline it 6 months forward before. This kind of assumes that like if the recession was starting today, this is how it lines up with the median pathway. But I like to also say it was like, well, maybe the recession 6 months from now. So like, does it line up well for that too? And in some ways, I'd say that lines up a little bit better because of at least this little downward curve, obviously. But as I said before, technically the bottoming point is still over here already. So until we reach a new bottom on the composite signal, I'm not going to say that it really is lining up all that well. So we have to continue to decline a little bit. But maybe we're a few months away from going into recession, or maybe we're recovering from weakness from, like I said, a year ago. It's basically one of those two stories, and pick which one conforms to your preconceiving political notions, obviously. And it also taking a look at that same signal, the composite signal, as I said, same signal I show right here. And this red line is also the red line in here, but going historically going back to the 50s. I've shown like this is why I'm doing this analysis, why I do this signal right here is that I put this together. Shows here's the recessions, here's how it behaves in and around recessions. It's not a perfect tool. It doesn't call everything perfectly every time, but I think it's a good signal, and I like it partially because it has all those pieces to it. Because then I can kind of break it apart and be like, oh well, if the signal is showing me going into recession right now, well then I can go look, well, which pieces of it is causing that, and do I agree with it, or is there something reason I can kind of explain it? Obviously, like for each of those pieces, I had a little bit of story for it, right? So it's one of those things where it's like you can decide how accurate it is in the moment based on the context of the situation. So that's my recession indicator that I've put together over the last year, that I'm quite like and still kind of use. I've tweaked the calculations in it a little bit here and there, but for the most part, I'm pretty pleased with this. So moving on from that, I also have several other pieces kind of looking at the economy that I've put together that I've shown previously, various other composite signals of leading parts of the economy, which include like durable goods and residential building and business investment and things like that. And I showed like several other time series on the Fed website where I kind of show those parts of the economy and how they can kind of lead economic growth in various ways. So here's a good example of that where I have the green line shows real domestic product year over year. You can see that's the GDP growth that we usually talk about. And then here I've composited the employment level of construction with the employment level of production occupations and employment level of transportation occupations and the employment level of sales and related occupations, taking as an average, and then the year over year change of that. And you can see like how well that correlates. Now, like the actual value isn't necessarily correlated. You can see like this value seems to be a little bit lower than this value, but the movements are very well correlated. That's kind of the point, and specifically in and around recessions. And then also this is a quarterly series, whereas this is a monthly series, so you can therefore also get that information a little bit of ahead of time. As I had said at the start of this, I waited partially till this date to do our quarterly show because employment data shows up at a certain part in the month, and so that's the thing, is that you can the employment and inflation data in many ways is more timely than a lot of other economic data. Um, by a long shot. So some data you have to wait like almost 2 months for, and other data you get the next day. It's like it's a wide range in how quickly you can get data, and I'm talking about like the time from the end of the actual period to when you receive it. You know, so that's the thing. It's like it's a big lag. You have to wait most of the time through the third quarter before you have an accurate picture of what happened in the second quarter for quarterly data. That's a pain. So that's kind of why I'm doing this, is that this is one way through employment data that I can kind of proxy what may or may not be happening with GDP growth. And overall, and see here, we were definitely having some kind of weakness, but as I showed before, it's like there's often kind of weak levels. It's really you don't want to worry about is when it like drops into severely negative territory. And really we've been kind of somewhat recovering in recent months a little bit, so that's a little bit of a good sign. If we kind of try to zoom in a little bit on that, we can see it's really in the last few months, but it definitely is kind of tripping up on it. Well, it'd be nice if we could move into kind of strength a little bit, as we saw more like here in 2017, 18, 19, or something like that. But we'll see. Maybe we can get back up into there in coming months. Moving on from there, I also do the same thing with industrial production through business equipment, construction supplies, and durable goods. You can see it's kind of a similar concept, but with different versions of data, also monthly. And then you can see how well these time series can correlate with each other. So it's just a good way to kind of look into it. So this one has been performing very well all year. Productivity really has taken off in a lot of those more industrial sectors. The employment hasn't really taken off super well. The sales hasn't necessarily taken off super well, but the productivity has, which in many ways is a leading element. So potentially those things will follow in the next quarter or the quarter after that, hopefully, unless obviously things knock the knees out from under them, which there's plenty of things that could do that, like effects of tariffs, but we'll get into some of those later. But overall, things are looking pretty good on this picture as well. Then also doing kind of the same thing with manufacturers orders. We'll cut so I have 1,500 tabs open. I do the same thing basically with manufacturers orders. And I actually have two versions of it: a simple average version and kind of like a weighted average version of it, but they're basically the same. But another time series of kind of looking at it. This is another one that often spends its time in kind of negative territory a little bit. So really, it's more about when it drops into severe negative territory, not just when it's like mildly negative. You really want it to be like many percent negative on a year-over-year basis. And so in that time frame, we're at like a couple percentage points, but we've been that way for literally the last like 2.5 years. So it's like we're not great, but not doing like absolutely abysmal. Certainly not falling off a cliff. That's definitely the point right there. So we'll definitely monitoring this one, but things are looking okay in that picture. Then doing the same thing with like actual sales within certain economically sensitive subsectors. So kind of similar concept, but still a little bit different. Like here, it's total vehicle sales, one family, homes sold, personal good consumption expenditures, and then taking all of those and adjusting them into a real figure by adjusting for inflation, this dollar figure amounts. So, but either way, you can see this one's much more volatile because it's a little bit more of a idiosyncratic series, but still it works pretty well. I think it actually leads a little bit better, but you kind of have to read between the noise before you see it actually leading into the recession very well. But zooming in on that one, not super great, but as you can see, it doesn't have to be super great. You just have to be not super negative. That's basically the what you're trying to avoid. So still okay on that picture as well. Then doing basically the same thing, but with personal consumption expenditures, also looking pretty decent. Um, Doing the same thing, but with real GDP measures, also looking pretty decent. So you can see pretty much across the board with GDP growth is looking at least okay. Looking at least okay, if not potentially moving into positive territory. The business cycle signals were showing weakness over the past year that we've been somewhat slightly recovering from. So certainly, a lot of headlines that I've seen over the last 6 months have, I think, been blowing some things out of proportion. in terms of like the at least severity and the speed at which some of the severity of those things will show up. That's not to say negative things won't show up, as I did put it in the title that we're going to talk about tariffs a little bit and the deficit. So we're definitely going to get to some details about though that is something that I think is some things to worry about. How the tariffs will affect the economy is something that nobody really knows. So we'll definitely have to see how things could move from here for the rest of the year. But what I would say is that I think a lot of people have missed, and I even did a show where I showed my calculations on some of the effects of what tariffs could do, and I basically said that we could have anywhere between a relatively modest okay year this year to potentially a decently not great year by the end of the year. And I said that it was a pretty wide range, and I had low confidence where it was going to be. And so I do think it's much more likely that we're not going to have like a super bad year this year at this point. But that's partially because I myself in my own calculations, and then plenty of the headlines I've seen over the last several months have not taken into account. I think some of the balancing effects. Like there's plenty of negative things happening, but there's also like certain other things, certain positive or at least balancing out effects that kind of like they balance out the scales on some of those negative things. So a lot of people don't think in counting those things. Like for example, a lot of people talking about how the big beautiful bill is going to blow out the deficit, increase debts by 4.5 trillion over the next 10 years, blah 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 blah, something like that. And it is not great in my opinion to let the continue to let a bunch of taxes essentially disappear that are extra revenues for the government. Though a lot of people tended to not notice the fact that those projections didn't really include a lot of tariff revenue coming in too. So they were getting rid of one tax, which is basically making the corporate tax changes from the previous administration permanent, but they didn't necessarily include some of the net changes on like the likely tariff revenue being included as well, or some of the deregulatory effects of the bill as well, and how those things would change it. So it's one of those things where it's like I would say the big beautiful bill was probably not a great bill. Like I'm not calling it a beautiful bill. That is what it's named, but it's definitely not. No deficit making bill in my opinion is beautiful. I do sort of agree with Mr. Musk at least on that specific point. But it is one of those things where the effects of it I think are a little overblown. A lot of the but anyway, little tangent there. Like I said, I wanted to get more details about the deficit and tariffs and stuff about that there. But continuing on with the economic data, here we have the unemployment rates by different little sub industry sectors, different subcategories of professions. That's more the way to think about it within the economy. Each of them you can see have different kind of like average levels. Some of them have different levels of cyclicality to them as well. These are unseasonally adjusted series for all of them. But overall, kind of zooming in, I would say it's like things are not super bad. In fact, some of them are declining over the last several months, but it could be declining because of the cyclicality aspect. So you have to one of those things where it's like you don't really want to judge only over a 3 to 6 month period for these series because they're unseasonally adjusted. You really do have to look over like 1 to 2 years, and they're at least sort of flat-ish over 1 2 years with like maybe a slight tilt upward. But that slight tilt upward, I would say, is even going back potentially like 3 years or so back to 2022. So it's like I would say things are pretty stable in the unemployment scenario for the most part, even within different subcategories. Because like focusing in on some of them, you can see there's some volatility in there. So there's a little dip down for this particular one, but I wouldn't call it a big deal because it could just be some volatility with the series. Definitely doesn't stand out too much. This is one's down a little bit, obviously, but this is one of those ones that has that kind of cyclicality to it. So it looks like it's a normal actually. And then like normalish, 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 so like yeah, there's potentially a little bit of uh, some movement where you could say some things are happening, but for the most part this looks about normal. Zooming in on that, that's the unemployment rate, which in many ways it takes time for that to really kind of show up. There's the initial claims here, which I like to adjust for the civilian labor force, so it adjusts it for population change over time. Obviously, spiking COVID is really hard to kind of see here. This means like look back historically speaking, how does this normally look going in and around recessions? You can see it kind of bottoms, moves up pretty quickly usually. So it's not something that like moves up slowly when we're going in recession. It's something that definitely can move up, but that's usually kind of like random noise behavior unless you're going in recession when it starts to really move up. So then if I go over to the last couple of years here, zoom in on that. This is really the last 3 years.
definitely some zigzagging here. People are kind of noticing it is sort of a little bit of an upward trend, but it's not a precipitous upward trend. This is a little bit of an upward trend too, but it looks more just like in the normal flow of things here. In fact, this peak point back here should be calling your attention, right? Like as a percent of the civilian labor force, we're technically below our peak from like 2 years ago. So sort of uptrending, but below peak levels. That's within a channel by definition. So not a big deal. This is the initial claim. So then looking to see like, okay, this is on a weekly basis who's filing for unemployment essentially. Well, the continuing claims is basically okay. Well, how many people are still doing that a week later? So within that kind of time frame, we can I think it's COVID before, so you can kind of see a little bit more normally. Still sort of the same thing as I was saying before, where it moves up pretty quickly. You can kind of have this bottoming behavior before, but it moves up quickly, kind of typically a very slow rate type behavior. So then zooming in on the last couple of years, definitely have an uptrend, but that uptrend was much more precipitously moving in 23, and then it leveled off at the end of 23 and in 24. And yeah, we've had a little bit more upward movement last couple months, but I would definitely need to see more months of much fast moving behavior before it starts to worry me. Zooming out to 5 years, this is out of COVID, 10 years, like we're still really really low. So one of those things where this is probably in my opinion the best employment measure to watch to really get an idea of it, because like the initial claims one is a little bit earlier, but you can see it's much more noisy. And so this one is literally only a week. It's like 1 week delay in that previous information, but it's much less noisy. So just by delaying one extra week, you get a much cleaner data sample, and then it's still basically like a month or two ahead of unemployment, because it takes some decent amount of time before people really fully end up in like category of unemployed and unable to find work appropriately. It takes some time. They really count it, depending on how they answer the survey question, basically. So yeah, probably one of the best ones measured. And I adjusted for the civilian labor force, but to be honest, you don't really need to. It's not like it changes that dramatically. I'm being a little bit of a nerd by doing that, to be honest. So that is. Um, Anyway, also moving on, then we also have hourly earnings by different kind of like subcategories of sub industries. Really just kind of showing overall kind of like strength of different industries of earnings power. Keep in mind that inflation is currently around 2.5%. So kind of like the lowest ones we have right here is 2.43%. I'm seeing for production and non-supervisory retail trade. So that one's maybe at about inflation or just below inflation or so, or maybe just above inflation. I can't remember exactly what the year-over-year inflation is. Really. Plus, which one you're talking about is obviously the question too. But most of them are a little bit above inflation. We do have positive earnings growth for the most part for most categories, at least a little bit. These are averages, obviously, so medians are probably a little bit lower, but that is what it is. Then getting to inflation specifically, we have several charts kind of showing within that. Here, a lot of the main kind of indices of inflation. Here's the headline number, personal consumptions headline, producer price kind of headline, and the core for each of them: core PPI, core PPP, PC, and then core PPI. All these pretty stable period. You can see kind of all pretty stable around like 2.5% or so for like the headline numbers, except for producer price. Producer price being the exception, because that one tends to be a little bit more chaotic and leaning. But I'll see that the core PPI is still kind of around 2.5%. So really, it's just like the PPI including food and energy that happens to be a little bit more chaotic, which makes sense because it's probably the food and energy specifically that's causing it. Of course it is. Of course. Here, PCE is broken into different subcategories. We have durable goods versus non-durable goods. See, durable goods. This is one kind of interesting detail I did want to point out, is that durable goods is, as you can see, actually usually negative. Like this is a subcategory that usually we have kind of standard deflation in, at least since the mid '90s. And by the way, that partially has to do with globalization and like our supply chains with China. That is actually like a major function of that mid '90s period is roughly when that relationship started to expand the way it did. So that's partially why you see that the way it is. But you can see that we did kind of bottom in this number around the negative 2.5% here in, what is that, 2022, 2023 or so. And then you can see it's been moving up It's at -1% or so now, so it's still in negative territory, but it's been moving upward or so. I would say that that's actually probably where you can see the visible effects of the tariffs maybe coming in right there. So it's like that is price changes because of that. But I will point out, I'm calling it price changes. I'm not even necessarily going to call it inflation because, as we saw before, we weren't really seeing it showing up in the overall inflation number. But that's because it's a relative price. Just because this price change doesn't mean the broad base overall price level changed, which is what inflation refers to. All right. So it's one of those things where it's like, just because prices are going up at the port doesn't mean other prices are going down somewhere else to balance it out, which is exactly what is happening. Which is why, because I said this months before, when I was talking about tariffs, as I said, it's like a lot of people have this perception. All the headlines were saying this. They're all saying, "Oh, tariffs are inflation, tariffs are inflation, tariffs are inflation." It's like, well, not really. That is a misunderstanding of what inflation actually is. You're thinking inflation is price go up, so therefore tariff makes price go up, and therefore tariff is inflation. It's like that is that's not inflation. That's not inflation. Inflation is a broad based increase in the price level, not price levels at the port specifically. You have to see broad base, and you only get broad base changes in the price level because of changes in the money supply. That's the reason why that happens. It's like, every, as Milton Friedman as often said, inflation is everywhere and always a monetary phenomenon insofar as that, and increases in the money supply faster than increases in the availability of goods will cause prices to increase. So it's all about the increases of productivity relative to increases of the money supply. Which is why you can have money supply increases and not really have inflation occurring, because you could have productivity increasing appropriately, which is, by the way, why you can have companies be profitable and still have negative inflation across the prices being sold to them, because that's productivity gains. That's what you're seeing right there, essentially. By the way, it's the same reason why, if you look at like a technology inflation index, you'll see that it's probably got a lot of negative, or at least very low inflation to it, because productivity is deflationary. It's the good form of inflation. So I'm pointing that out because, like I said, it's one of the visible areas you can actually see the tariffs coming in, but yet you don't see it in more of the like more headline numbers. And there's a reason why that is, because a lot of people are misunderstanding this. In fact, I said it before. It's like, in many ways, tariffs are more likely to cause deflation, if anything, and not the good kind. They could potentially cause the bad kind of deflation, which is what happened during the Great Depression. A lot of people harken back to the Great Depression when they were talking about the tariffs, but that's a, that's the it's deflation that was the problem there. Though I didn't think that we were necessarily going to have a Great Depression type scenario either. But the point is technically speaking, you're more worried about a drop off in demand, which causes a drop in prices, because a drop off in demand, which is deflation. So yeah. But anyway, moving on from there, I did want to point out these other series though. This is the services PCE number, which you can see is still up at a relatively high level. What is it currently at? It's at 3.5%. 3.5% for services, personal consumption expenditures, which includes a lot of those hourly wage gains. By the way, like I was showed that chart before. You may have not have realized it necessarily in the moment, but that time series looks very similar to these inflation time series, because in many ways that was an inflation time series. It was just focused on specifically the inflation of the money received by consumers from their employers. But that's one of the costs that goes into these things, and for the U.S. economy, a lot of that is services, right? So that's where you see a little bit of a hotter inflation number is in the services category, and you can see where it's hotter on average overall historically, but it's also hotter than it was historically currently still. 3.5% versus the average of 2.5% prior to COVID. When we were having lower than 2% inflation prior to COVID, and yet 2.5% services inflation what we had there. So you see there was like a 1% difference there back then, and we still have that 1% difference here, between the services and the normal headline inflation, 3.5% versus 2.5%. But now it's stabilized at 2.5% versus a little bit under 2%, which is why I believe that we're not getting inflation basically any lower than we currently have it outside of recession. But then there's also these market-based ones, which a lot of people point out, where these ones are also a little bit more timely in that they don't rely on surveys; they rely on more like market-based prices. But those are also pretty stabilized around 2.5%. So moving on from there, also have the producer price index broken up by the stages, which is kind of a neat time series. It's a little bit different than a lot of the other inflation series, because this kind of shows like the different stages of production. So showing how like these prices typically move up a little bit first, and then these ones follow, and then these ones follow, and then these ones follow, and then this is the final demand PPI, which is the PPI index that most people are generally talking about when they're talking about the producer price index, is this one right here. But then there's these subcategory ones that kind of show how the different categories move first, and then other people have to raise their prices to reflect the previously raised prices that they experienced. So you can see that like the blue and the green and the orange ones go down and up first, and then they kind of drag the magenta and the kind of violet with them a little bit, right? That's kind of how I would describe it. Then moving on from there, I have these subcategories. The PCE with services X housing. So this is kind of the core PCE. And then I also had like the categories of food and energy. So those are the categories that are separated from that. And that's one of the things I said to kind of wait for a little bit later. I was going to show you is that this is the reason when I said when I was showing in the composite signal earlier, I was showing you inflation. I was showing how inflation is actually usually high going into recessions, and then it usually declines during the recession because of the decline in employment activity. And this is actually one of the time series that shows that. It's largely because of energy. Energy is usually the big culprit there. There's other stuff involved. Usually, it's not just energy, but energy is usually the most volatile aspect. So you can see right here, like those big spikes right before going into recessions. That's very, very common. And then you have a big, drastic negative downward move, kind of halfway through or near the end of the recession, pretty consistently across the historic time series there. So that's one thing I would point out there is like that's one of the reasons that inflation behaves the way it does around recessions is that energy makes up a big chunk of the cost in there on the headline number, and it has a big effect, has a very, very big effect. Then shelter, and then also kind of want to let's take that time series, move it over because it kind of makes it impossible to see the other ones because of that. I want to just take it out. Food one's also a little chaotic, but it's still a little bit better. Still a little bit. But here, so now kind of like moving within that. Zoom in a little bit. Shelter is another one of those categories that is just relenting on being higher than people want it to be. It's at still about 3.87%. So this one's even higher than the services category. As you can see, though, it is coming down. Now, this is largely base shelter. I have rent to primary residence, which is kind of like subcategory within that. You can see they're pretty similar. And then owner's equivalent rent. So three different versions of kind of housing inflation here. They're all very, very similar, you can see. But all of them are higher than the other categories have been. It's coming down, but taking their sweet time coming down. They come down at a very smooth pace. You can see these are very smooth measures. That's because they're based on surveys for the most part, which is one of the reasons they take so long to come down. A lot of people have talked about that. If you can kind of you could replace that out of the index with essentially like a realized rents index. A lot of people have done this with various versions, Zillow indexes and things like that, to argue that inflation was lower in the last year or two than the headline numbers show. And there's some arguments to that, but I also think there's some lack of credibility to those arguments for various reasons as well, because that only is taking the current supply on the market into account, but that's not taking into account there is always potentially new supply that could come on the market. And so you have to take into account what those people who are not currently on the market, what they believe prices should be, because if they're going to put something on the market, they're going to put it up on the price they have, and that's means it's going to take even more time before essentially they're forced to bring the prices down, or the market's forced to bring the prices up. Either way, prices have to meet for a transaction to occur. So it's like there's arguments. I think it's a fair argument on both sides. That's basically how I would say it. Is that there's some fair arguments for why these time series are okay, and there are some fair arguments for why the realized rents indexes would be a little bit better. But either way, I the realized rents index are also in some ways potentially already bottoming, and these ones have still not all the way worked their way through the Python. So it is something I do worry about going forward. A lot of there, I am paying pretty close attention to the housing market pretty broadly, partially because I am invested somewhat in the housing sector to a certain extent. But I am very curious to see what happens with housing. It has obviously been in a super lull for the last couple years, which we saw in some of those series I showed earlier about like construction worker, like construction productivity and the construction jobs and employment stuff that have been very, very dwindled for the last 2 to 3 years. So depending on what happens with rates over the next year, as I kind of said earlier, we may start to get some movement in the short term rates, at least by kind of mid time next year. But that doesn't say anything about the long term. Like the long term rates is going to be the real question to the housing sector, which I have some comments on later. We'll get into more stuff about the deficit and tariffs and stuff like that. I am kind of slowly painting a full picture here, but there's a lot of moving parts to the economy. The economy is complicated, guys. Who would have thought? You know, believe it or not, it takes 45 minutes just to give a brief overview of like everything going on across some categories of the economy. It's like I said at the start. In some ways, it's kind of good to do this as a show that I come back after like 2 months of not streaming, potentially on a day when I didn't have a whole lot of chatters here to show up for, which is cool because I had a lot to talk about. So in many ways, it kind of works for me just to be ranting at the camera here a little bit today. A lot of things to talk about. But either way, the point is, I'm curious to see what happens with that. The weakness in the housing market is very regionalized in some ways, but I'm curious to see just how much that could spill over into other regions. You know what happens. So it's like in some ways, there's a lot of people who believe we're kind of like on the verge of another housing collapse. There's some validity to some valid parts of the argument, but I also think depending on how you look at it, we could be basically be at the bottom now. You know, it's like one of those things where it's like a lot of people think, oh no, housing prices are going to decline 20% nationally or something like that. And it's like, no, we got like a 2 to 3% clip. And that might be about all you're getting, you know, which for the financial system is probably good. But for housing affordability, maybe not. So that is what it is. Um, but that has to be solved through other ways, frankly. That's a whole other complicated topic. But like, frankly, the housing affordability problem can't be solved with demand tools, but interest rates and stuff like that. Or well, I mean, technically, you can argue supply side tool, but it affects demand. When I say I want to affect supply, I mean you literally want to affect regulations and availability of construction supplies and construction workers and things like that, like building permits, regulations, and things like that. Like those are the things that are going to make it easier to build in this country and therefore help availability. But a lot of that's local too, so that's complicated too. But anyway, moving on from this category, I do want to talk about a little bit more about employment, but more specifically, because now we're going to talk a little bit about deficit stuff. But I wanted to kind of add this kind of addendum on some other topics from earlier in the year that people were talking about. We talked a little bit about the Doge stuff in some of my previous streams. I did kind of want to like I said, addendum some of the details about that, which is to say that like many months later, here we are. The there was not a big wave of unemployment caused by federal workers laid off. That was definitely um, a lot of scary headlines for mostly not. So here I kind of want to show employment in government over the years because this is something I think most people don't necessarily understand the full picture too because that maybe can explain some aspects too. So showing kind of like historically what's happened. Here we have all these things adjusted for percentage of population because again I'm a nerd so I like to do things in that way where we normalize things based off the population. So you can see historically we had what is this 1.3% federal employees, which is the blue line as a percentage of the population, up until kind of around the 90s or so. Then it kind of started to decline a little bit towards about 1%. Then we went under 1%, and then it's kind of normalized around 0.85 or so, 0.85% for the last 10 years. It's kind of stayed at around that area, give or take, for the most part. So we were kind of already thinning out as a percentage of the overall workforce, which probably makes sense because we have a very, very large economy, right? Like, it doesn't necessarily need to be consistent. And also, technology is improved, so you might be able to argue that you can improve things efficiently in that way as well. But then I would also point out that like there was also this other change here. I included these other lines showing state government. A lot of people they focus on the federal employment when they were talking about that the layoffs earlier in the year, but they weren't talking about the state employment and the fact that that's actually much larger, much larger, and that's another place that those people could theoretically go to work, do similar things, similar type of work, provide similar types of services. So one thing I just kind of want to point that out is that like you actually zoom in on it, we didn't really lose that much in terms of percentage of population of federal employees. I did the calculation. It's like 70,000 employees or something since the start of the year in federal employment has been lost approximately. But that doesn't take into account the increase, which has been a slight increase in state employment, only slight, not 70,000 worth. So I don't know, I didn't do the math, but it definitely wasn't enough to completely balance it out. But there was an even larger increase in social assistance employment. So that's the third line I included here was social assistance, which you can see has been taking off actually, um, ever since the 90s. I wish we had it going back even further because I would kind of be curious to know like where where in the kind of the growth period began for that, or is that just consistent over time? But the point is, I include that because in many ways, that's kind of like outsourced government work or government like work, right? Like helping people work. We're going to categorize all three of these as helping people work, right? Like people are doing jobs, they're trying to make money to pay their bills like everybody else, right? It's not any different from any other job in that sense. But the theoretical goal of the organizations is different for these three lines than other areas of the economy, right? That's how we can at least kind of categorize it different. So that's the thing I would point out here. And then zooming in on the more recent time frame here, the last 5 years, 10 years, you can see that here at the start of the year, we actually got like a noticeable bump up in the social assistance category. Heads. Um, there's actually a visible bump up there. There's like a slight downward decrease in the federal one. You can sort of see it like curving down a little bit, but it's just like a curve down slight. Whereas there's like an actual like a little like jink in the social assistance one. So that's what I would point out is that in many ways I think the services being provided by a lot of the people that were laid off through the Doge layoffs early in the year. I think in many ways a lot of that stuff has been covered by social assistance. It looks to me like both the employment was overdone, but more in the you were to add up all three of these categories, the total of all three categories is higher today than the total of all three categories was in December 2024. So that's kind of the thing I would point out. It doesn't say what these people are doing. It doesn't say what organization they work for, but that's like nonprofits and stuff. So just the employment aspect, because a lot of people did think that literally the federal employees themselves was going to be enough to cause like a recession, and I was like, guys, it's a tiny part of the picture. Now, like I said, I would worry more about the services that those people were providing to the rest of the economy, right? Like that's the thing that would I would say affect more people. But even then, I'm not worried about it in a recessionary sense. I'm just worried about it in a, you know, not wanting people to be homeless or otherwise destitute because they didn't get whatever service they were maybe previously getting or something like that. Like I am all in favor of balancing the budget and cutting all sorts of deficits and stuff. I'm in favor of a lot of the Doge stuff, but at the same time, you can have empathy. A little of a mixed bag between those two things. But anyway, so that's one aspect of it. Another piece of employment I've been monitoring throughout the year because I was concerned to see like how a lot of the changes with the new administration might affect things. That's more relevant specifically to my portfolio is construction employment. So here I have employees in residential construction as a percentage of the population, and then also I included a larger measure that is residential construction, but also including residential special trade contractors. So it's a little bit of a larger. See, it's a little bit swingier too. And so like overall residential construction has actually managed to be pretty even throughout the year, which is good. I was definitely concerned about like definitely like a lot of people were saying, oh well, this is definitely where some of uh those immigrants potentially that are being deported, maybe this is some of those jobs right here. So that could be a problem, and therefore like it could be, which is a lot of people are saying, well, oh well, that's fine. Well, then you can hire Americans, and like I said, I'm not trying to say what we should or should not have done on any of those political issues. I'm just trying to think about how it affects the economics and therefore my portfolio, right? So in my mind, I'm thinking about it's like, okay, well, do they have to raise higher wages to do that? Which is fine, but the point is, do they have to do that? And does that squeeze home builder profit margins and things like that, right? So something I was kind of keeping my eye on throughout the year. So far, it looks like residential employment has actually done pretty well through the year. You can see that if you include the contractors, it has come down a little bit. Let's zoom in a little. Last 5 years here, so you can see like the contract, including the contractors, peaked last September as a percentage of the population and has been coming down basically for approximately a year now, give or take. Whereas just the purely residential number has gone up. So I don't want to make any assumptions right there, but who knows? Maybe that was where some under the table employment was happening was in the contractors, and maybe you can see them kind of being replaced there. But like I said, total guess, total assumption. I have no idea. I have no stake one way or the other. In many ways, I actually have no opinion really one way or the other about those things. I honestly was didn't mind those workers being here, but I'm also fine with whichever way it goes. This isn't a political show, so we're not here to make opinions about what should or should not have been done. We're just looking at the effects of it. But so far, this is looking good. And then also, like I said, kind of looking at it historically, um, time series start 5. You can see this is also one of those time series that declines pretty quickly and somewhat precipitously going into some recessions. At least the 2 out of 3 recessions pretty solidly. You can see it did so in 2000 as well, but definitely not as deeply. But either way, the 3 recessions that we have on this graph, it definitely did that. So this is also yet another thing that definitely does leans more in the doesn't look like a recession yet kind of camp too. So then, okay, moving on from there. Now let's start talking about deficit stuff. Um, Basically finish most of the main kind of governmental stuff. But let's look at the deficit over the last. This is one of the other things I'm kind of paying attention to through the all the Doge discussions during the beginning part of the year. Everyone was arguing about 1 trillion, 2 trillion. Oh, actually, it's only 100 billion. Oh, actually, you know what? Doge is over, and we're no longer talking about that. And actually, we're passing a big spending bill. Sorry, we're reversing course on that. But like I said, I always said from the get go, it's like I'm all in favor of cutting government spending to pretty dramatic levels because I do believe it is like a massive cancer on our society that will drag our country under if we're not careful with it because debt is a very scary thing that can get underhand. But at the same time, I also was very doubtful that they were gonna get much success by trying to bring them in there to cut some of the parts of the non mandatory spendings because a lot of the problems are actually in the mandatory spending categories. That's the issue. Frankly, there's not a lot of political will to touch those things like Social Security, and Medicare, and people often talk about defense, but I would argue that we actually have a lot of good reasons to maybe not want to cut too much defense in our current world. But people like to argue about that one too. And then a lot of people also talk about obviously the interest expense, which is one of the other main categories, which really you have to sort of like wrangle in the other categories because then that convinces the bond market that you know what you're doing, and then therefore they'll give you lower rates, and then you can lower the interest. Right? It's like one of those things where it's like you have to fix one problem in order to get the other problem fixed. But anyway, so here this is looking at the federal outlays minus federal receipts, basically on a monthly basis. So it's like here showing like this is what is contributing to the deficit on a monthly basis, and then the red line is the current expenditures minus current receipts as a percentage of GDP. So it's like showing that over time as a percentage of GDP. You see, prior to COVID, we were at about 5% or so. In like 10 years prior to COVID, it was between 4 and 5%, give or take. And then ever since COVID, we've kind of been more like 6 to 7%. In the most recent quarter, it was at about 6%, or so. So uh, I kind of showed it in the thumbnail. I don't know how many people actually necessarily look closely at it, but we actually did have a budget surplus in this most recent month, which came out in the last day. And a lot of people, I saw some people headlining it, and I kind of wanted to talk about it a little bit because I actually feel like there's a good chance that our our president will call this out in the next week or two because it's going to be something he'll probably want to take like a victory lap on. It's one of those like silly things where it's like a technically true but kind of meaningless thing. So therefore he's probably going to tote it as a great victory. Which I mean, in some ways, it pretends a potentially good thing. So that's one thing why we're going to talk about it a little bit is that it is a good sign. It's a good sign, and I will show you why. But it's one of those things where it's like it's a good sign that we don't want to make too much out of yet, but we'll keep an eye on it. Definitely keep an eye on it. So here, pointing out, I'll show is that anytime the graph, the blue line is negative, that's a surplus. We're showing the deficit. So the positive number is the deficit. The negative number is the surplus. Okay, so that's something important to understand there. The way I've like framed the graph. So here you can see that there are points on the graph where it's negative pretty regularly or so, but there's something that kind of special about those points of the graph. They actually have something pretty special in common. Like prior to this most recent one here in June, the most recent one we had prior was actually April, where we had a $258 billion surplus in that or not that month. Whereas this month for June that I'm talking about is only a $27 billion surplus. So like, why am I even pointing out a $27 billion surplus when in April we had a $258 billion surplus? And the reason why is because if you look back historically, we actually have a lot of these positive ones in April. Um, Not all of them. There are some other ones that sometimes pop up here and there, which is one of the reasons we don't want to make too much of the one we currently have here. Because but April is tax collection month, so in April we often have a big amount of money coming to the government, and so that's why you don't want to make too much out of that necessarily. But the fact that there's a positive one in June is actually a little bit of a surprise. This was unexpected. And part of the reason it was unexpected is has to do with the with tariffs. Tariffs have been actually coming in a little bit stronger than expected, which back to what I was saying a little bit earlier uh, about the big beautiful bill, where a lot of people have talked about how the tax cuts for the corporate tax being extended is going to blow out the deficit. $4.5 trillion added to the deficit over 10 years. Blah 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 blah. But that assumes a lot of things, and it doesn't necessarily take into account a lot of other things. So it's like it's true that that does add to the deficit, but it's not adding not actually taking into account any of the baseline changes on the taxes from last year compared to this year. And we've already seen a pretty decent increase in the first quarter with just even the small changes that we've had in the current tariff code already. Because keep in mind, we keep postponing a lot of the higher levels of tariffs, so only certain levels of the tariff laws have actually gone into effect from the changes from last year. So it's one thing where I pointed that out is that we already have a pretty big difference in the usual kind of cyclicality of the monthly budget statements here, even though we don't have the full tariff policy kind of like worked out yet. And I'm assuming that I don't know, everyone has different assumptions about what's going to happen, but be honest, I don't really assume we're going to get a million more trade deals. If you'll notice over the last few months, not a million countries have come running to our doors. We've had some countries come for trade deals here and there. We'll maybe get a couple more here and there. But at the end of the day, I do think Trump is going to have to either, make some sort of final decision on what like permanent tariffs are going to be, and or back off entirely off them. And I do think it's probably more like he will actually decide some sort of permanent tariff level. I don't really merit to take a guess at what that level is going to be relative to the current ones or the announced ones or whatever. I have no idea. But point is we're probably going to get some tariff potentially a little bit higher than what we currently have. And all of that I think is also still dependent on how the market reacts. So like one thing I'd also point out there is that obviously we had the big reaction in the market to tariff day earlier on, right on here, Liberation Day, right? And then we've recovered basically to all time highs since then, and which only gives basically a complete go ahead to the administration to say, okay, well, the increases in tariffs that we've already put in place obviously hasn't made the market freak out. So that means we're okay. So now they're like, okay, well, let's push it to see if maybe the next higher tariff level will improve things a little bit more, right? So it's one of the things where they can keep pushing the tariff levels higher, higher, higher until it breaks, and then they can pull it back a little bit and then hope that maybe that breaks. That might be the strategy that they're literally doing. I have no idea. I'm just playing games trying to get in their head here. But the point is like that might literally be what we're doing here is that basically just like seeing what we can get away with in terms of is the market going to freak out or not? Is the economy going to get pulled under? And all the data I showed you before is that the economy is not really getting pulled under, not yet anyway. Now we've been a quarter or so since Liberation Day. It's been 2 quarters since the administration took office. I would like to see at least one more quarter or two more quarters on kind of both of those fronts to really give a more solid confirmation on that, but on whether the tariffs are really pulling us under. But like as of yet, it's definitely not the case. Now, so looking at the tariff revenue, you might say, okay, well, what do you do? $96 billion annualized rate in Q1, up from $86 billion. So like, so what? That increased by like 15% in the first quarter. That's a pretty big increase, but it's not a huge amount compared to trillions of dollars. You might be saying, so what? So like, as a percentage of GDP, let's look at that as a percentage of GDP. Here you can see, which is not a big amount. Here you can see like I would say on average over this time series, we're looking at like what 25 basis points, but that's a basis point. We're talking about in terms of GDP growth. Think of it in terms of like that. It's that if we were talking about or not growth in terms of the GDP deficit. As I said here, it's like we have a 6% deficit to GDP, and currently or prior to this administration, we were looking at kind of around 30 basis points. Now we've only increased it by maybe about, like I said, 15% since then. But even previously, we had already had a little bit higher levels. I think and this is only with the current increases on tariffs. As I said before, it's like we may in fact be getting a doubling to tripling of the current increase from basically where we were last year. So I'm kind of mixing my words up. The tariffs where we're currently at as of today over the tariffs of where we were at the end of last year, that increase we could experience 2 to 3 times more, depending on how many, like I said, the permanent tariffs that we sort of end up with at the end of the day. The point is like I could see this actually ending up being 50 basis points, 60 basis points, it could maybe even approach potentially close to 1% of GDP. A few years out, it could potentially take a few years to kind of reach that level. But the point is like, some people may be underestimating how much this could contribute. It's not going to solve the deficit, which is like, what the administration in some ways was trying to paint the picture as, but it could actually start to meaningfully contribute. And that's the point I am trying to make, is that this could bring the six down to 5.5, or even potentially down to five. And then also that's just in isolation. That's not taking some of the other parts of their program into place. How that could bring this six down to potentially a 4 to 5% again, which is what I think they actually might potentially be able to succeed in if they play their cards right. Now, there's plenty of ways they can screw that up, and there's some smart people in the administration and some dumb people in the administration. So it's like one of those things where I think there's definitely kind of like a battle of heads between, I think, some people that know the correct moves to do and other people that absolutely want to go the complete opposite direction with it. So it's one of the things where it's like this is kind of in many ways like a best case scenario. I could see the end of this administration, we end up with a deficit to GDP of like 4 to 5%, which would basically be putting us back where we were during the decade prior to COVID, which would be pretty nice. It wouldn't be the 3% of GDP that Scott Bessent was when he was auditioning for the Secretary of Treasury role. He was basically advertising that he thought he had a plan to get us to 3% deficit of GDP, and I don't think we can get to 3%, not without like serious entitlement reform, to be honest. But I do think we could get back to 4 to 5%. And to be honest, I think the market would honestly be okay with that. That's the thing. It's like, again, we were at those levels for some time. Like, let's zoom out a little bit and see like what we were doing here with the percent debt to GDP historically speaking. We're kind of looking at this very closely here. Like, look at historically. Now you'll see historically back prior to the 70s, we had it was like maybe 1% on average. Like, there were periods where it was surplusing, and then there was periods where we had like 1 to 2% positive, and that was like during recession. Like, this was like the responsible Keynesian economics period. This is when they were taking Keynesian economics seriously, and they actually responsibly implemented it. And I'm not really a big fan of Keynesianism, but at least they were implementing it like kind of to the book here. And then in the 70s, after they broke off the gold standard, in fact, they broke off the gold standard so that they could do this. Actually, basically, there was no way they could do this without essentially giving up all the gold during the gold standard. So that's part of the why they did that. And then that level kind of moved up more to averaging for between like the 70s to the 90s. I'd say like that, like what, an average of 2 to 3% or something. It's definitely a little bit more volatile, hard to say. And then in the 90s, you can see we had a nice period where it was declined back to zero. In fact, for the second half of the 90s, it was negative. That was Bill Clinton balancing the budget, which was then immediately reversed course. And then we've basically been blowing it out as a percentage of GDP ever since. But the point is, I do think we could return back to essentially the decade post GFC and prior to COVID. I do think we kind of get back to that level pretty within reason, as long as like the current administration play their cards appropriately. Which, by the way, when I'm referring to like the smart people versus the dumb people in administration, Scott Bessent is the smart man in the room, in my opinion. Like, to be honest, like give him the keys to the White House. In my opinion, it's really the how I look at it. You know, but I will say, he does seem to be one of the preferred jesters these days. So that is, I'd say, a good sign. But anyway, another way kind of to think about this, like this is showing like those as a percentage of GDP figures, and then like the monthly statements of the budget. But then here I'm showing just like the rate of change. It kind of like shows like similarly the same thing. Um, it's like receipts as the percentage of or receipts minus expenditures. So like above the line is when we have a surplus, and then below the line is when we have a deficit for this. And then here I have GDP minus federal debt, right? So both of these are showing a year-over-year growth basis. So basically, like the economy is healthy when these lines are above zero. Both of them. You want both of these lines above zero, and that means the fiscal situation of the economy is healthy. When they're below zero, that's when our fiscal situation is deteriorating. It's like technically our debt can be whatever size we want it to be, as long as these lines are above zero. That's basically how I look at it. It's like it literally like doesn't matter how much debt we have as long as these lines are above zero. Because as long as these lines are above zero, the debt market will look at it and say, okay, they can eventually pay it back. It's like that's basically like what how that defines it. It's like as long as these lines can move above zero, it basically means that you can grow your GDP enough to pay down the debt in the future. And really like that's the green one primarily that has that feature to it. But then the blue one is kind of like the short term one that turns into your kind of co but the green one primarily is that one where the essentially the debt market looks at it and says, okay, it can do that. And like zooming in, like it says, like you can zoom in on that. We were pretty negative for a few years. So like this is the reason why the bond market was starting to freak out a little bit is that these were pretty negative and didn't look like they were going to be recovering anytime soon. We had been negative for some time for the most part and weren't recovering. We blew it out and then we didn't really recover it too much. But in the last quarter, it is maybe starting to improve a little bit. Like I said, the blue line has improved. It is above zero. But the green line isn't quite yet, but it's very, very close. It's very, very close. So it's one of those things where it's like we may be starting to get there. And like I said, like a couple more months of getting this kind of activity here, if we can continue to collect significant amounts of tariffs without, for example, other types of taxes rolling off. Like that's the way you kind of have to think about this: is that the tariffs are a tax, right? It is a tax. A lot of people try to like, oh, it's tariffs are protecting American workers. I know all the arguments why they're using the tariffs or whatever, but it is a tax on Americans. The companies pay them, but then the companies pass them on to consumers for the most part, or they hit the profit margins of the companies, and then that means the companies hire less workers. So it's like one way or the other, it comes back to the consumer in some form or another. So it is a tax, and that is what the government's doing. It's like they're raising a new tax. The question is if they raise this tax over here, how much does that affect the other taxes over here? That's the question. And so far, it's going better than expected. Like that's kind of like the way I would look at it. But it's really like only a couple months so far that we have to look at. It's like only a couple months. So we really got to see a full year really would be nice. Like, once we get back to like January 2026, and we're looking at this, or really we would have to get more to like March 2026 because then I could get the as a percentage of GDP figure. Because 2 month lag approximately on GDP numbers. So that's why like this red line's way back here, even though this blue line's way over here. It's that 2 month lag that we're waiting on. Because like this number right here is probably gonna be like 5.5 or something. I don't know. For Q2 or something like that. Or take. I don't know. But the point is I expect I kind of feel like GDP is gonna be potentially better than expected. Or I shouldn't say better than expected because I actually don't know what's expected right now. Could be that everyone's expecting what I'm saying already. I don't really know what day it is. So I'm looking for the expectation right now. But the point is I am cautiously optimistic. Like I guess I don't know. It's like if that's like the way to kind of summarize a lot of what I've said here. It's like there's plenty of dark clouds on the horizon. There's plenty of ways things could go wrong, and a lot of that has to do with um, which economic advisor wins the ear of our president more on any given day. And right now, Scott Bessent seems to be, like I said, the preferred jester in the court, which in many ways is good because he's the one that knows how to speak to the markets better in a large way. So that's good. So like getting into that, I will say let's talk a little bit about markets, but related to the treasury market. Talk about the treasury market. I wish I'd prepared a different graph for this here, but we'll uh, here Fed up, put here 2 year up, and let's move these guys over. Have these all in the right spots. Spreads on this one, yeah, that over enough to kind of paint the picture of what I'm trying to paint. Um, so here we have the 10 year and the 2 year. The 10 year and 2 year, and the spread between the 10 year and 2 year is the main candles image as well. So you can kind of see the spread between the two, but also the two yields independently. so we can kind of see like which ones are moving in which direction and cause the spread to move in which direction itself. Now, talking about the Fed and talking about those budget things, as I said before, a lot of people think that maybe in the next meeting or two we might actually start to get a cut, but it's also some people think that we won't get a cut because Jerome Powell seems to really not want to, and maybe they'll they'll replace Powell next year. Some people think that Trump's going to replace Powell early. I don't necessarily think that's likely to be the case. I think there's some chance that he'll name a new person early so that like the market knows who that person is, and then they can start giving speeches and start talking. A lot of people have been talking about this as the shadow Fed idea, which I do think that's potentially the way they will play it. But they won't fire Powell, I don't think. I think that that's unlikely to do, partially because I think Besant will advise him not to. Whether or not he listens is the other question. But yeah, it gets back to, like I said, the smart man in the room argument. But here you can see those two, and I'm bringing it up because this has both effects on the economy, but also relevant to my own portfolio in pretty large measure. So like this is something I've been thinking a lot about is the yield curve and the Fed and what's going to happen here. So people are talking about that. Now, what the government wants is they want the Powell to bring down the federal funds rate. And I'm showing the 2 year here because the 2 year is kind of like the market's way of sometimes predicting what the Fed funds rate is going to do, but also like saying what it's actually going to be, right? So like in many ways, the Fed tries to do what they bring rates up and down, but oftentimes they're just following the 2 year. So anyways, this is kind of like the market version of like the short rate that people pay attention to. It's also like the short term rate people use for measuring the yield curve spread most commonly. Some people use 10 year and 3 month or whatever. But anyway, 10 to 2 year here, and then the spread between. So you can see that the 2 year has been actually kind of starting to trend downward. I would actually point out a lot of people may not even realize this that both the 10 year and the 2 year peaked 2 years ago, almost at this point. Like we're almost to the 2 year point since both of those yields peaked. But a lot of people don't think of it that way. They're just like thinking, oh, high rates, high rates, high rates, bring the rates down. They don't realize the rates have actually already come down. They haven't come down a ton. They've kind of just like channeled down a little bit. And the 2 years done so more than the 10 year. That's one thing that's worth pointing out here. Is the 10 year is much kind of like steadier sideways range, but it's true that it still has not peaked since that same point there. The more recent peak here in January during kind of like the bullishness going into the administration, and then there was also kind of the peaks here in May with some of the deficit concerns. But both of those peaks were lower peak points than those previous. So we're getting lower peaks on the 10 year, not higher peaks. On not a huge market technician, but that's some technical talk for you. And then the 2 year is doing it even more consistent. Uh, Lower peaks and also lower lows as well for that one. So you see kind of coming down a little bit. So I would argue that no matter what happens with Powell, at least this kind of same move in the 2 year is likely to occur. Now, if Powell was to leave the Fed, we would likely see an even quicker downward move because if the next Fed chair is going to be like a Trump sycophant potentially, and do exactly what he says, well, then yeah, he might actually lower the rates, and that will probably bring down the 2 year rate. But the thing is that the Fed doesn't really have as strong of a control over the 10 year. In fact, they have very little control over the 10 year. The 10 year is mostly a market instrument. Now, the Fed does have some power over it when they're doing quantitative easing and buying up significant purchases of the 10 year. But in terms of the interest rate, just as a set interest rate, they don't really have any effect at all. That's set by inflation and growth expectations for the most part, and credit expectations. So that's why it's like this one, like you see, it is potentially moving downward, but it's moving downward at a much slower rate, I would argue. So one way or the other, the spread is going to get wider, which is what we've been seeing over time here. You can see here, this is the spread between the two. Here's the 0 point. So this is like when the curve is inverted. We inverted in mid 2022. We had an inverted yield curve here. It moved up pretty significantly, and then it reached uninversion approximately was it September or so of last year. And we've been moving upward. So the spreads, the amount of interest being charged on future loans that are loans that are due even further in the future is higher than it is in the shorter future, which means people have further expectations in the future of higher inflation or higher growth or some combination between the two, which generally speaking, people look at it as sort of a positive thing. But obviously, the federal government doesn't like it because they want to be able to roll over a lot of their debt. And then it gets back to like I got one, I think. I don't know. That gets back to this discussion over here because like one way that they can improve this without having to make major changes to policy is just by getting that interest cost lower, as I talked about before. It's like the Social Security, Medicare, and Medicaid is really really difficult to touch because a lot of that is mandatory spending in various ways, and then the defense spending is also a difficult spending category to touch because of kind of how important it is, also how politically sensitive it is. But then interest expense, a lot of people look at it as like, well, look at all this money we're spending that we theoretically just don't have to spend. Trump, which is why Trump keeps talking about the Fed so much um, in tweets or in whatever. And if this spread continues to go up, it makes it a lot harder for the government to finance on the long end of the curve. Um, there was a lot of criticism of Janet Yellen during the last 4 years with Biden as his secretary. She was financing a lot of the curve on the short end, which is closer to T bills. She was issuing much more T bills than long end of the curve. A lot of people were saying, "Oh, it's because you're trying to make it so that the yields don't go up as much and trying to manipulate things so that the yields don't go up. You don't have as high of interest costs." And it's funny because one of the people that was making those criticisms was Scott Bessent. I myself also was making criticism, and it's funny because Scott Bessent is now in favor of that policy. And he's kind of come around and basically said, "Oh well, he hasn't said it, but he's basically come around to her point of view now that he's the treasury secretary." And I understand why he's doing it better now than I did when Yellen was doing it, partially because he and other people have said more about why they're doing it. Um, but I still don't necessarily agree with it. But anyway, the argument, what they're trying to do now, like I said, is they want to get the 2 year lower, either in the short run with a shadow Fed or next year with an actual appointment to the Fed potentially, which means, like I said, I don't know that they're going to be able to drop rates 200 to 300 basis points, which is what Trump says he wants to do, which would be like bringing it down to here or so. Like, I kind of have my doubts that they'll succeed at that, but I feel like we can maybe at least bank on the same movement we've already seen. It's like I feel willing to at least bet on kind of a continuing momentum in the yield, which means by like midpoint next year, I could see it coming down to like 3 to 3.5%. We're currently at 3.8, 3.9%. I could see it maybe have at least come down to 3.5% 2 years. Not the Fed, like I said, this is a market rate we're talking about. I'm not trying to make political predictions of what the Fed's going to do, but maybe just look at what the market's doing. The market is trying to predict what the future is going to portend. Let's assume the market's right, and it's trailing this way because this is what the market's prediction is. So if we just carry it forward, let's assume that it's kind of around here. And then, well, let's assume that the 10 year also continues to do what it's doing, which is basically not moving at all. So it's also at 4 to 4.5% here, which means we would have from 3 to 3.5 to 4 to 4.5, which means we would have spread anywhere from uh, zero point 0.5 to 1.5, right? So the average of that would be about 1%. So that would mean that this curve right here would move upward to about here. So just interesting to point out. Like I said, why talk about this? I was talking about a decent amount because of how it's somewhat relevant to my portfolio. As I said before, um, I show that a lot of forms, logarithmic, and also we're gonna go off that. And within the logarithmic too, actually also adjusts for inflation and super normalize this time. Um, so anyway, the reason why I'm paying attention so much to the yield curve is because um, upward sloping yield curves equals higher profitability for many. I don't even necessarily want to say the majority of insurance business models. It does depend on the type of insurance you're doing, so that's why it somewhat kind of matters. But it does apply to specifically type of insurance, fixed index annuities, and index universal life insurance that in particular sells. So that's one of the reasons why I'm paying attention to this, is that this, I think, is a macro factor over the next year that's going to play a big role in potential profitability for FG. It can lead to higher sales for those industries too. But that also kind of depends on the absolute level of the rates as well, because like the absolute level of the rates kind of defines some of the attractiveness to the consumer, but the spreads define some of the profitability to the actual companies themselves. So having adjusted these the insurance index here for inflation and turning into a log chart means that essentially in many ways you would expect kind of like a normal inflation level of appreciation. Um, or you would expect like if inflation is 2%, you would expect that like 4 to 5% of appreciation to be almost a flat. Okay, so that's what rides like here. Anytime it's relatively flat, that's actually like essentially normal growth. Anytime it's like sloped upward, that's actually really fast. Okay, like that's the reason why we did it this way, is that it's kind of scrunches it down to make it so you can see the changes over time. Again, this whole time series is going back 15 years, and the index has moved up a decent bit in that time frame. This is kind of a way to look at it. But I'm showing you the yield curve against that because one thing I want to point out here is that um, the movement of the yield curve actually helps define whether or not you're going to get those fast rate of change periods. So, like for example, here it's a little bit difficult to see because the absolute level of it doesn't necessarily matter too much in certain ways. So you can have it move downward in a trend over time, long ways like this way, but then having different movements like this will still affect its kind of movement over time. And I want to kind of zoom past the Great Recession because the recession itself is going to throw off that trend a little bit because of the unemployment levels happening at that time. We really just want to focus on the effect of the rate change itself, and have other big economic factors coming in and affecting it as well that have to explain multiple things at once. So like in general, like here, you can see that like this is at a high level and it's relatively flat up here. Like I know these things up here in the way, but kind of zigzagging back and forth up here. And we have a relatively fast rate of change level going on like this. And then you can see it declines pretty quickly to a higher level than it was in the previous zigzags here for this period right here. And then we have a big drop off in the insurance index, both in inflation and logarithmic adjusted ways. It takes some time for it to fully recover. Again, in a logarithmic chart, that means like this recovery here is just recovering back to trend essentially. And then that's approximately at the same time that you can see that the spread started to increase pretty significantly again. Again, like it even bottomed here, and from this point here where it bottomed up to where it peaks here, you can see that suddenly we had a fast upward sloping rate of change. Again, like flat versus upward sloping, what we're trying to point out. It doesn't have to be much more than that. Just like look at the flatness of the steep versus the steepness here. So like this upward slope right here correlates to this upward move right here. This downward move right here correlates to this kind of more flatter period right here. And then we have a little bit of a bump up here right here, which is does kind of bump up a little bit, and then another downward period right here where it's again flat right here. An upward bump up right here where it bumps up right here, and then a downward sloping right here where it then it kind of pulls up a decent bit right here, but then it gets pulled back under afterwards a little bit right there. So it tried to fight it a little bit that time, but it didn't manage to really do it very strongly. So then where it comes down to here, it doesn't quite bottom here, but this is sort of the bottom in the trend point right here. Technically, it bottoms a little bit further right there. But you could argue maybe that the market was looking forward a little bit. It was starting to see that, hey, we're already at basically zero here. Like this was the bottom prior to COVID, right? So like a lot of people were looking at this probably being like, it can't go any lower than this. So this, maybe they were kind of looking forward in that point and bought into it prior to that. Then we had COVID, which kind of threw things off a little bit. But then after COVID, uh, it started to increase precipitously, which part of this is probably recovery from COVID, but nonetheless, we do have a pretty fast upward sloping curve there. And then at some point here, suddenly it started to just drop off a cliff. When it dropped off a cliff, what do we get? A flat period followed by some even more struggly period. And then you can see it kind of bottoms at the edge of the cycle here at this point here, which happens to be pretty much damn near the bottom of where the spread bottomed approximately, give or take here, before then this takeoff that we've had most recently on the spread, leading to this takeoff in the insurance ETF, which now my head is way up. So I I hope maybe you can see why I was focusing so much on the yield curve spread and why that's relevant to me, considering my number one position, 20% of my portfolio, is a company who that sells products that are quite relevant to that. I've looked at the correlations of various of those insurance and annuity numbers from like the FG spreadsheet that I have with all the information. I've run various correlations of information there, but I figured I would just show you in this graph form. Not with FG stock because obviously FG has only existed since the end of 2022, so it's a very short graph. I can't really show you with FG, and also because of the fact that they're growing so much in terms of like their market share, not just the operations itself. It's gonna skew the picture. So that's why I figured it's like let's just look at it with the insurance ETF and see like why this is relevant with the insurance broadly. You could do the same thing with the financial sector broadly, I think, as well. But I think the correlation is even more clear with just insurance broadly. So that's why I'm paying attention to this pretty closely. And again, my thesis essentially was that the 10-year is going to basically go nowhere over the next year. But I think that we can count on the 2 year at least coming down another 50 basis points. But probably I would say even maybe closer to a full 1%. It's like somewhere between 50%, 50 basis points, and 100 basis points. I think is the decline we'll get on the 2 year over the next year. And I think the 10 years has good odds to really go nowhere. But nonetheless, that would bring this spread upward, which I think would be a boon to FG's profitability. And the fact that the 10 year went nowhere would, I think, also be a boon to sales because, as I said before, I do think the absolute level of the long term rate is incentivizes sales of annuities to consumers, but then the spread is a boon to the profitability of the sellers of those products. So it's kind of like a different relationship in terms of like how it affects the companies. One's a top line effector, another one's a bottom line effector. But point is like I actually think the next year could be positive for both of those aspects. I feel more confident, I would say, on the spread widening because I do think it's possible that we actually do get there's some potential outcomes where we do have a decline in the 10 year and a decline in the 2 year, but they're together and it's faster. And it's because we did actually end up going into recession, and that would maybe not be great in the short run for those companies. It could be good maybe in the long run. I don't think so. It's like it. You can looking back to like I said this time series, you can see like the recession parts were more like temporary breaks in this relationship, and then we saw it kind of bounce back to that relationship. So but how that would affect FG would depend a lot on the employment situation because that would depend on what happened both with the people who hold their products and also with the companies that make up the loans that are within their portfolio. Like those are the two ways which it would be relevant to them. So anyway, like I said, big diversion to talk about this particular detail of markets and how that relates to. Like I said, it kind of relates back to the deficit discussion because I do think that there's a huge strategy here related to that as well. So like I kind of talked about this in relation to my portfolio, but this is like I said, relevant to the deficit discussion because they want with if the 2 years lower, they plan to essentially roll over as much of the debt as possible on the 2 year, and then they plan to try to wait a year or two for the economy to be doing better, and hopefully, like I said, maybe having more tariff revenue come in, maybe improve the deficit to like I said before, maybe back to like 4 to 5% of GDP by I don't know, well, I'm just guessing, but like by 27, by 2027, 2027, 28. And then at that point, then maybe they can roll over as much of debt as possible into the long term rate once they've gotten this one down to, maybe into like the low threes by that point. Hope, maybe, possibly, hopefully. Um, I imagine they would hope they could get it even lower. I imagine they hope they can get the 2 year down to 1% and the 10 year down to 2.5% or something like that. But I don't know. I don't know about that. To be honest, because like I can make arguments for the 10 year also going up over the next 2 or 3 years as well. But my base case is that the 10 year goes nowhere and the 2 year actually does come down. So, and that's how I think it plays out for my number one. So that's going to be, I think, basically it for today. As I kind of said, it was first show back after some kind of erratic streaming schedules. So in some ways, it was convenient that not too basically nobody showed up to chat with me because I had a lot of things I kind of want to talk about. So I was able to kind of get through everything today, which is kind of nice. Um, uh, as I said at the start of the stream, I am trying to keep to a little bit more of a regular schedule. I actually did put together kind of like a planned schedule in terms of not just like, oh, okay, this is how often I'm gonna do my shows, but I actually kind of like laid out, okay, on a cycle, I'm going to cover this kind of content on this show, and then 2 weeks later, I'm going to cover this type of content, and 2 weeks later, I'm going to cover this type of content, and then I've kind of created a 3 month cycle for my shows based around each quarter. So this is the first show in that cycle where it's like we're going to cover the economic data from the previous quarter, and then we're about to go into earnings season here soon. So basically, 2 weeks from now, I'm going to have one show, and then we're going to do 3 shows like that, rapid fire, probably mostly covering earnings season, and then we're going to have shows after that where we cover changes in my portfolio, and then maybe stuff like that. You'll see as it goes on. So we'll talk about some more things like that. As I said at the start of the stream, I have changed my macro momentum strategy a little bit, and I haven't changed too much my individual holdings. So we'll probably talk about that strategy in one of our future shows. But I will probably be making some more changes in my portfolio here in the next few weeks as I start to roll out the new template, which I didn't show any of it to you guys here today. But here's just a kind of a quick peek of how that looks. But uh, it's a little bit different than my other ones. I didn't bother making a distribution tool with this one. Like I said, with the previous compared to the previous ones, the goal of this one was in many ways to make it quicker and simpler to just kind of throw all the financials into the template and have it kind of automatically put together various assumptions for me. I do have to tweak them based on the company a little bit, but the point is it does a lot more of things automatically so that I can kind of think about it that way. But one thing I really wanted to do with this one is that it kind of creates several different ways of evaluating it, both one based on earnings, one based on cash flow, and also taking into account changes in the balance sheet, trying to reconcile all those. That's kind of like one of the things I did a little bit differently with this one compared to some of my other templates. But you'll see how features kind of play out over time. But like, as I said at the start of the stream, one of the reasons I did this change was to make it easier for me to hopefully do many more valuations a lot quicker and build up a much larger kind of dashboard of evaluations on a kind of a going basis. Because I felt like my previous template, while I liked it, I thought it was really cool and how some of the features worked, and I found that it was kind of slowing me down. So it wasn't really that great in terms of trying to use it. So yeah, but anyway, like I said, we'll see more of this in the future. So that's gonna be it for me today here. That's it for our Q2 Macro Matter show. Thank you to anybody that decides to watch this on the replay. Please like the stream. Please subscribe to the channel if you're not already. Please, ring the notification bell. Join the free Discord. The link is in the description below, and I'll see you all next time.